Good Monday morning from the Asia Pacific, just half an hour from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Tang Wilkins.
Our top stories this morning. European leaders are racing to craft a plan for Ukraine's security, including a coalition of the willing, after the clash between Presidents Trump and Zelensky.
Now, Chinese investors are facing a pivotal week here with high hopes that the National People's Congress may deliver further stimulus to counter U.S. tariffs. We'll have discussions on the economy and business environment as we count down to the two sessions.
And China's largest bubble tea chain, Mixue, is set to debut this hour after Hong Kong's biggest IPO of the year.
Good morning, and again, welcome to the show. It is Monday. It certainly doesn't feel like we had a weekend. Everything from, obviously, the dust-up that we saw in the Oval Office over the weekend, certainly events after that. We had PMI numbers out of China, and on that note, we're looking ahead to NPC. Markets are on better footing right now compared to, I guess, how we ended the day on Friday in the Asia Pacific, and then we had, of course, that continued rebound into the U.S. close. That being said, though, as you can see, U.S. futures are in the early goings of Monday, pairing some of the gains earlier on. So we're now down a tenth of 1%. The dollar, as you can see, is reversing a lot of the strength that we saw going into the Friday close. We'll talk more about the PMI numbers and what that perhaps means for the context we're coming into this NPC meeting and the NPC, and of course that work report where we are expecting them to effectively outline, of course, economic targets this year, and then some more. Perhaps we'll see. A couple of other things to note as well. Okay, so in Singapore, we're coming online there. One stock that we've been tracking, of course, resuming trade today. City Development's down about 6-7% in the opening minutes. At the reopen here, of course, there's speaking of dust up there within the board itself. I guess we can talk more about that corporate room drama a bit later on in the show. 2s and 10s right now ahead of the jobs report, of course, later this week. And broadly speaking, though, risk appetite is better, but not solid going into the open today. Right. Korea's closed. Just a, I guess, housekeeping reminder that Taiwan, though, is reopening today, and that's coming up on your next board, of course, after that, I guess, being shut on Friday. TSMC is down about 3.4%. That is some catch down, of course, to the sort of price move we saw, that pullback that we had in Asia Pacific on Friday. Crypto, yes, we're down, but compared to levels this time yesterday, Sunday, of course, we're up about 10,000 US dollars in Bitcoin. We'll talk more about this later. And of course, the approach to the Chinese Open following that massive pullback that we had in price on Friday. And we are called higher ahead of course, a fairly pivotal week. By the way, speaking of PMI, we have the Caixin numbers coming out this hour. Stay tuned for that. And, of course, as it pertains to these tariffs that are set to kick in, as it pertains to expectations around the Chinese currency, Goldman Sachs have come out with their note. They think 740 is the price we're looking at on the exchange rate. On the nominal rate itself, when you look at things like implied and expected vol over the next week or so, it doesn't seem like anything that has been announced so far has taken people blindsided. We have been talking about this for some time now.
Yeah, we have. But sort of two big rival stories now. On the one hand, we have the MPC coming up, a big focus, of course, on what the offset is going to be for tariffs, some of that sluggishness, the over-reliance perhaps on the export market in China. But also, of course, we have this big geopolitical story developing when it comes to the US, when it comes to Ukraine. And just thinking about that a little bit deeper, the UK now has called for a coalition of the willing to secure Ukraine after any US-brokered ceasefire, as European leaders met in London. Prime Minister Keir Starmer says Britain, France and others will work with Kiev on a ceasefire plan.
Not every nation will feel able to contribute, but that can't mean that we sit back. Instead, those willing will intensify planning now with real urgency. The UK is prepared to back this with boots on the ground and planes in the air. Together with others, Europe must do the heavy lifting.
Now, those comments coming through after Volodymyr Zelensky left the White House abruptly on Friday without a minerals deal or security guarantees. It's following that heated exchange with President Trump.
You're not in a good position. You don't have the cards right now. With us, you start having
not
cards.
Playing cards.
Right now, you don't.
You're
playing cards. You're playing cards.
Serious.
You're gambling with the lives of
war.
millions of people. You're gambling with World War III. You're gambling with World War III. And what you're doing is very disrespectful to the country.
Let's bring in our team now. For the latest on Ukraine, we have Bloomberg News Desk editor Jill Dacus and our China correspondent Min Lo is in Beijing, looking ahead to the National People's Congress there. Jill, we'll start with you. Really pretty extraordinary scenes in the White House over the weekend. What does this mean for a potential ceasefire and U.S. relations with Europe?
Well, ultimately, Rebecca, I think what we're seeing here is this idea that the need for Europe to really sort of step in and ultimately be sort of the lead in sort of brokering something here with Ukraine. It's really thrown into sharp relief when you see that very disastrous meeting between Zelensky and Trump and his Vice President Vance in the White House over the weekend. Trump has really kind of been making this case for the last several weeks now. He's been saying pretty much that, Europe needs to be out front. We've seen Trump, kind of willing to expedite negotiations with Putin, really. And I think, what you're seeing out of Europe, not just this emergency meeting that we just had on Sunday, but also, that meeting in Paris just a couple of weeks ago, is Europe really kind of scrambling and trying to figure out a way forward here. I mean, I think that what's notable about this emergency meeting that Keir Starmer hosted here is that it's not this giant coalition of everyone that's involved in the EU. I mean, you're seeing, everyone from, Germany, Norway, but also Canada attended this. You have Italy talking here. I think it's really that reality of Europe to say we can't just wait for every single member of the EU, plus Britain to kind of get on board here. They need to sort of broker something, and they need to broker it fast because they're fast approaching a reality where you might have something involving Ukraine that doesn't come with that guarantee of American-backed security. Yeah,
as he pointed out, it is time to act, not so much more words here. We did hear as well from Vladimir Zelensky, and I guess in so many words, if the conditions are right, if he did get an invite back, that he is still willing to speak with President Trump. Yes, I mean, I think that, despite, how we just all saw that meeting go, you did have Zelensky, repeatedly say that he still does, ultimately want to, develop some kind of a relationship with Trump, get back to the White House. I mean, I think that there is that understanding that, at the end of the day, still Ukraine, and I think certainly the EU at this point would prefer that America be involved, the U.S. be involved in some kind of negotiations here. I mean, still obviously, the U.S. has been for the last 3 years, really critical for supporting Ukraine militarily here. I mean, that's something that you don't necessarily want to just go away. And ultimately, I mean, you want to make sure that the U.S., that if you're Ukraine, if you're the EU, that you have that same seat at the table with the U.S. if, ultimately, Trump sort of goes in and starts negotiating with Putin. So I do think that, at least for Zelensky, that's a channel that he wants to keep open. But again, I do think that when you've got these types of, EU meetings kind of coming together here, it does, sort of suggest there that the EU still, at least Europe more broadly, still has to be sort of front and center going forward for any kind of negotiation. Jill, thank you so much. Jill Dacus there on the latest on the Ukraine front. Let's get to Min Lo now. Of course, she's in Beijing for us to cover, of course, this big 2 sessions taking place this week, economic targets and everything in between out of China. Perhaps maybe some context here as well on the external challenges to this economy, tariffs, whatnot. Min, just talk us through tariffs, of course. They're set to take effect. And how does that really color what we are expecting to hear out of that work report this week?
Yeah, so we have the 25% tariff that U.S. is imposing on Canadian and Mexican goods that was supposed to kick in February. They're going to kick in tomorrow, although Trump officials are now saying that that final number is still not set in stone. So about 24 hours ahead of that deadline, looks like there are still going to be this last-minute negotiation. We know that Scott Bessent has signaled that it would be a good idea if Canada and Mexico both match the U.S. tariffs on China to create a sort of North American tariffs there. So could be more potential tariffs coming from Canada and Mexico on China. Of course, the additional 10% tariff on Chinese goods from the U.S. administration is supposed to kick in tomorrow, U.S. time midnight, which will be Beijing time around 1 p.m. tomorrow. That's when we want to look out for how China would respond, whether they would announce their own set of countermeasures to those tariffs tomorrow, a day ahead of that NPC. And so far, their measures have been very targeted, slightly less than proportional in scale to the U.S. tariffs. Will we see China continue to adopt that stance of strategic patience here? Because we did hear President Xi last week urging officials to remain calm and composed amid these external challenges. But you got to wonder what is preventing both President Xi and Trump from picking up that phone in that call that President Trump had said was supposed to take place as soon as possible. Also got to wonder how long Beijing's patience will last, because at some point, if they feel that President Trump is not negotiating on good faith, they might shift towards a more aggressive and assertive stance as well.
Yeah, Min, on your point about the sort of strategic patience that we've seen from Beijing so far, nonetheless, we have seen China take some efforts to support its economy. What is it doing so far? And are we seeing signs that that support is actually having an impact, having read-through?
Yeah, well, we did get the PMI numbers over the weekend, and pretty good set of numbers there, beating expectations on the manufacturing front, coming in at 50.2 versus 49.1 the previous month. Non-manufacturing coming in at 50.4, in line with estimates. And it's a good set of numbers that I feel like she still masks the weakness in consumption, because you look at non-manufacturing 50.4, that consists of two prints, the construction PMI and the services PMI, and most of that number is being pulled out by construction, which came in at about 52 or so. Services PMI came in bang in the middle at 50, a contraction from the previous month, which shows that purchasing managers perhaps are expecting this pullback in spending, perhaps after the Lunar New Year. And also that's despite the government measures so far, the expanded sort of equipment upgrading program. We have seen the effects there with an increase in spending in these very specific sectors like household appliances that benefited from the program, but it hasn't really translated into a very broad-based sort of recovery in spending. Small pockets here and there, Nerja really boosted box office spending, but luxury goods and the like still not doing so well. So in terms of what we could see from the NPC, we want to look out for how much the government is going to fulfill their pledge to boost consumption this year, as opposed to relying back on their old playbook of using industrial policies, investments to try to boost the economy. In terms of consumptions, will there be maybe moves to strengthen the social safety net, to include migrant workers in more participation of social services, public services, so that they can free up more cash to spend on other things? So that's what we'll be looking out for in the NPC.
Okay, Bloomberg's China correspondent Min Lo in Beijing across every element of stimulus support, tariff response that we're expecting to watch for this week. And still ahead on the China show, BNP Paribas joins us to discuss fixed income assets. We'll get more on China's MPC with former AmCham Shanghai president Gibbs and former PBOC advisor David Daokui Li. Plus, we look at what's next for Ukraine after diplomatic talks with the US were derailed. And we're counting down to the Open, just sort of 20 more minutes or so away from the Open, and of course that Mixue debut coming into the Hong Kong market as well. Good morning, happy Monday. This is the China Show.
Right, welcome back. Happy Monday. You guys are just in time. Your first reference rate for the week is out 717.45. Not a big variance there, if you will, from what we've seen so far. That goes really into what a big week this is, right? You have the work report, you have the NPC, of course, and everything in between. You have the jobs report coming through later on Friday. And, of course, as it pertains to China, right, the CGB pullback in yields that we saw, I think, last week. So far, we had a cap at a 1.8%. Buyers coming in at that. Does it remain the cap this week? I guess it depends on what we hear, of course, out of the NPC as well. Plus, it depends, of course, what we hear out of Donald Trump and Ukraine. Let's talk all things fixed income. Speaking of the CGB yield, and bring in James McAlevey, head of global fixed income at BNP Paribas Asset Management. Good morning.
Good morning.
Where do you want to start? You want to talk about the Fed? Or do you want to talk about this dust-up in the Oval Office?
Let's talk about the dust-up. It's hard not to, isn't it?
Yeah, okay. So far what the market's done with Trump policy is they've had a look at, say, defense spending in Europe, for example, commentary that's going to pick up. It showed up in the equity markets. Defense stocks have done very well. How does that affect in your world?
Yeah, I mean, it's just harder to trace in a way because there's just not the same level of issuance around in defence issuance as it relates to corporate bonds. But I think we are seeing it in the government curve. This story is not new, right? This story's been around for weeks anyway. We've been discussing this idea of increased European defence expenditure now for many, many weeks, if not months. And it's quite clear that Europe needs to come to the table and spend more. I think on the basis of the argument that we saw in the Oval Office on Friday, though, it's even more relevant and it's even more immediate. We've obviously seen a significant rounding of the troops in Europe in order to support Zelensky. And what's clear now is that Europe are going to do their bit. When, how, we don't know. The total numbers, we don't know. But we know now that they're going to end up doing more than perhaps they were otherwise going to in order to try and save the situation, I think.
Okay, so somewhat less opportunity for direct read-through when it comes to the corporate bond space, but are there other proxies that you're looking at? And in terms of that sort of the broader Trump tariff story, are you reducing exposure elsewhere, dipping into anything else?
I mean, it's quite hard to try and disentangle the tariffs versus the diplomatic issues as it relates to Ukraine at the moment, but I think in a way they probably both collide full force in terms of the shape of the European yield curve. If tariffs come, I think the ECB are going to have to be forced to cut more than we otherwise expect or more than the market is pricing. But at the same time, I think the one real visible aspect of this whole issuance need as it relates to defence expenditure in Europe is what bonds are doing at the long end of the curve. 30-year European or 30-year German securities, rather, are now significantly underperforming swap. And we've seen a meaningful steepening at the back end of that yield curve that actually looks, somewhat in contrast to what we've seen in other global curves. So the footprint of all of those Trump policies now, I think, are stamped firmly on the European yield curve. And I don't think it's yet in the price either. I mean, we've liked steepness for a while. We continue to. I think Europe's the best place going forward.
And is that Trump footprint on policies, do I write the postcard to blame them for this pickup in U.S. Treasury yields, for example?
Yeah, I mean, it's a difficult one, isn't it, as it relates to the Treasury market? All of a sudden, we've seen a meaningful rally over the last 2 weeks. That looks a little bit out of context. It's difficult to try and translate that back to news flow necessarily. Some of the data's been weaker, for sure, and we now know that Besant and Trump are looking at the 10-year Treasury yield, so maybe everyone cares all of a sudden. But it is hard to try and justify the move we've seen, particularly in the context of more tariffs, of more inflation, of all of these issues and concerns the market had only a month or two back when he was obviously...
Would you chase that rally?
Huh?
Would you chase that rally in Treasuries?
I mean, what we like at the moment is it relates to US fixed income, our tips, essentially. We're thinking that we're entering a period now in the US where we call it stagflation light. It's hard to think of stagflation in the same way that we had it several years ago. But if tariffs are going to deliver inflation, we're now beginning to see a few cracks in US GDP numbers. It's lower growth, higher inflation. That's the perfect environment for US tips. So we like being long tips. We're staying long tips. We're benefiting from this move. But I don't think I want to chase nominal moves now down around 420 in US 10s.
If it's stagflation light, I think I know the answer to this, but explain your thesis here. The market's getting it right when it comes to Fed cuts and what we're seeing?
I mean, at the moment, my concern in a way is that steepeners globally have been a loved kind of thematic for a period of time. I think the out-of-consensus call would see yield curves flatten a little bit at the moment. The Fed are clearly on hold. The Fed are clearly concerned about tariffs. The Fed are clearly concerned about the inflation implications of tariffs. It doesn't look like they're going to have enough to move in the meantime, even if data continues to soften. So I think with the Fed more or less on hold here and data potentially weakening, that's a bull flattening of the yield curve. And that's a complete change to what we've been used to of late.
What about opportunities in credit globally?
I mean, I'm struggling with with how tight spreads are, I think. I think there's plenty of other opportunities in local emerging markets and US mortgages. But I think at the moment, spreads are quite tight, right?
Well, they have been tight for some time.
They've been tight for some time. And I think, as investors, we have to respect the flows in credit. And I think for us, it's been pretty obvious for some time that there's been an awful lot of flow coming to the credit markets on an all-in yield, total return basis. And I think that makes a lot of sense. But as professional investors, we're paid to look under the hood. And at the moment, spreads are tight, excess returns look like they're not great risk-reward here. I don't think you're being compensated for the risks that you're taking at the moment in corporate credit.
Fantastic. It's nice to see you. Let's do this again next time you're back.
Lovely.
You're back in town.
It's been a pleasure.
James, fantastic. James McAlevey, their head of global fixed income at BNP Paribas Asset Management. All right, 22 minutes into the pre-markets. There's one stock in particular we are tracking very closely, and you do see on the screens why that is. Trading debut here, the biggest IPO, biggest trading debut of the year so far, $444 million US. And looking at the first day price move, looks like bankers left some money on the table there. But then in case, of course, you give that to the secondary market. Anyway, plenty more ahead here on this bubble tea trading debut, plus other parts of this equity market to watch as we go into the first trading session of the week. 8 minutes away, you're watching The China Show. Good morning. Right, good morning and welcome back. So just a couple of housekeeping notes here. So South Korean markets are shut today, and the market that is coming back online today is Taiwan. And so you are getting a sizable move today in TSMC, although you split the difference between what it would have done on Friday and today. So let's call it down 1.5%. Down about $1,000 right now. There we go, on shares of TSMC. Right, just to pivot and flip the page, please, to look at the approach to the open. And, you know, we were down 3-4% on Friday. So you are getting some dip buying taking place. That's generally what we're seeing across the region today. Although, as you can see, quite obviously, not all the way back. One stock, of course, we were tracking very closely today is this Hong Kong's biggest trading debut of the year, biggest IPO.
This bubble tea ice cream giant really coming through. And of course, we've been watching really closely the IPO Hong Kong market, whether or not this is going to sort of open the gates to allow others to come through. We have essentially had this sort of regulatory pause on these kinds of names for quite some time now.
Yeah, clearly the gates are again open, and I think the oversubscription that we had on this specific one drove up some of their peers that were listed already. I think it's worth pointing out that some of them, if not all, except for this one, didn't have a good first day. I could be mistaken there, actually. I was reading, I could be getting confused. It's Monday. But so forgive me if I'm getting that one wrong. But certainly it's one to watch. I think 5,000 times oversubscribed.
Or more by individual investors. Yeah. I mean, rapacious demand for this one. Yeah.
Yeah. Well, speaking of luxury, Prada, 3.5% on your screen. Said to be closer to a deal for Versace, of course. They've been talking about that really for weeks. Clearly, they are in the running. And very quickly, cryptos, of course, very much in focus after Donald Trump and his Truth Social post on the weekend. And as you can see, that's playing out in the crypto space, in the equity space, within crypto. The open is next. This is Bloomberg.
Good morning. You're watching The China Show. Welcome back. We're counting down to the open of trade in Hong Kong and Shanghai. You're looking at live pictures from the Hong Kong Exchange there for the listing ceremony of bubble tea maker Mixue. And it's the mascots that are going to be hitting that gong, Dave.
Yeah, the Snow King is one of the mascots there. What would be an interesting plot if one of the executives was actually inside the costume?
I mean, it could be anyone.
It could be anyone.
This is a high-profile gig here, Dave.
We are waiting for that gong to be hit. There doesn't seem to be any clear movement, though. If they're really good at this game, if they're awfully steady on purpose.
Oh, here we go.
Here we go. Let's listen in.
Proof of life. There you go.
Oh, needed a bit more hip mobility on that one. Oh, there we go. Clearly, the stock is not moving laterally as they are. It's quite a vertical move we're seeing in the pre-markets. Gray markets were substantially higher. We're up about 30%. This is how some of my friends act, actually, at 4 a.m. on a Saturday morning after a fun night out.
This is what they look like?
This is what they look like.
I remember the last time I saw the HKEX stage just full of mascots. It's so brilliant.
This is how we should start every show.
Yeah, excellent.
There we go. And coming up, an exclusive interview with one of them. We'll see what they have to say about this $444 million listing, biggest one in Hong Kong so far this year. It certainly has opened up the gates, and they have followed many of their peers that have listed in this market. As you can see, the stock, by the way, the IPO price was somewhat near 200. As you can see, we're now trading at about 267 on that as well. Now, it's back to the broader markets, of course. There's lots more going on. This week, you have the NPC kicking off. You have the two sessions, of course, within that. There's obviously the dust-up that took place in the White House, and it's a developing story. We're continuing to follow that. Markets don't seem to be too bothered by that, given already the sell-up we had on Friday. So flip the page, please, and have a look at where we are in Hong Kong. So a 3-4% drop on the benchmark basis on Friday. The gains we're seeing in the open in minutes, 224 points in the Hang Seng, is just enough to take us back above the 23,000 handle. Right, just a brief update on the price of Mixue, of course, which is this trading debut today, up 32%. I would imagine substantial volumes are coming through. Get this, retail portion, more than 5,000 times oversubscribed. There we go, 266 right now is the price. Very quickly, other movers and other names we're tracking here. So New World Development out with earnings on Friday. Effectively, we're looking at still a loss there in continuing operations. Stock is moving the opposite way, up about 7%. The other one that you might have actually missed to our viewers here because of all the news that took place. There was a meeting between the PBOC related departments that took place, and 5 private firms were invited to that meeting to talk about ensuring financing. And the 3 of the 5 are actually on your screens: Inner Mongolia Ely, SenseTime, Geely, and 2 other firms. More on this in a moment. Crypto stocks, big move up in Bitcoin and Ether, 84,000 to 94,000 and change last I checked. And as you can see, that's playing out across these equity markets.
Yeah, Dave. I mean, just picking up on your point about this meeting with private enterprises and the PBOC, this big sort of question on the level of support that is going to be offered and the role that the private sector is going to continue to play when it comes to the MPC and it comes to some of these economic goals that we're expecting to see set out. So we have that annual meeting opening later this week. Just as, of course, we're seeing the economy showing some tentative, very tentative signs of momentum. But Donald Trump's tariffs, of course, are going to potentially test Beijing's ability to sustain that push. The meeting is going to set the tone for China's economic direction and its spending plans that we see through the rest of this year. Our chief North Asia correspondent, Stephen Ingles, has more on what to expect from the MPC.
This year's National People's Congress will be tasked with some heavy lifting to counter deflationary pressures at home. Congratulations. Compounded by political uncertainties from abroad.
We think 2024 was the year of understanding the beginning of reflation in China, but it's going to be a long, long battle.
Coming out of the first Trump trade war and then the pandemic, China doubled down on its industrial policies while simultaneously cracking down on the property sector, the internet economy, and of course, COVID. An over-reliance on exports has led to the challenge China faces today: how to address, without stoking excessive debt levels, the imbalances between industrial overcapacity and slumping consumer spending, while also bracing for a potential protracted trade war.
Priority of macroeconomic policies should shift from promoting more investment in the past to promoting both consumption and investment, with more importance attached to consumption.
Bloomberg opinion columnist Julie Ren says China's households sitting on more than $20 trillion of savings have hunkered down, spending less and creating their own self-care safety nets. Call it economic long COVID.
I think that's a fatal mistake because last year, consumption accounted for only 1/3 of the total GDP growth, versus 2018, consumption accounted for more than 2/3. So what happened last year was that basically China managed to grow the so-called 5% only because of strong exports. And that basically put China's economy in a very vulnerable position when Trump launches his trade war.
December's Central Economic Work Conference essentially set the NPC agenda to approve more public borrowing and spending this year but authorities have been short on specifics.
I think China basically has no good choices at this point, and President Xi has to make some sacrifices,
including vows to strengthen China's social safety net by boosting healthcare and pensions to an aging society and middle class that's been hit with massive paper losses on property.
I suspect the government will look at the economic development, look at tariff announcement and the responses in the economy, and potentially announce more. So basically, I think they need to work hard to stabilize the property market and boost domestic consumption.
The levers for the level of reflation are now in the hands of NPC lawmakers gathered here this week.
Our chief North Asia correspondent, Stephen Engel, reporting there. And Steve joins us live now from Beijing. Steve.
Yeah, that's right. It's great to be back in my old stomping grounds of Beijing. And I want to, of course, now bring in our next guest who can talk a little bit more about these policies that I just outlined that we're going to be likely addressing all this week, including, of course, tomorrow we'll be out in the Tiananmen Square outside the Great Hall of the People, where the CPPCC, the big advisory body to the NPC, will kick off its gathering, followed on Wednesday by the work report from Premier Li Qiang, where we'll get the outline, hopefully, of those stimulus measures to sort of counter that deflationary pressures. You are absolutely right, Rebecca. There is some momentum in the Chinese economy right now, and I think a lot of participants are looking for some policies to kind of maintain that momentum. Let's bring in Kerr Gibbs. He is the former president of the American Chamber of Commerce Shanghai, also the author of this book, which I'm holding in my hands right here, Selling to China. Well, you're the editor of it, Kerr. You compiled a lot of experts that we all know, whether it's Bill Russo from the automobile industry, Mark Fisher on sports, Ken Jarrett, and dedicated to our mutual friend, of course, Bob Theline, the late Bob Theline. What are you taking away on this NPC? How consequential will it be for the Chinese leadership to stimulate and reflate this economy?
Yeah, thanks, Steve. It's good to be with you again here. Yeah, the NPC, I mean, this year is probably the most consequential NPC that we've seen. I know you've covered this for many, many years, and I've been watching it for years as well. This is something especially foreign businesses look at very closely. I mean, the decision-making process in China is, of course, very opaque. We all know that. But the NPC is actually a really good opportunity as a communication vehicle. A lot of people say, oh, it's a rubber stamp legislature and, not a real decision-making body. Whether that's true or not, it is actually a very good communication vehicle to explain kind of what are the measures going forward, what is specifically going to be happening in the economy. So, and this one in particular is going to be very consequential. If you look at the challenges that China has had in the past, before other NPCs, you had the Asian financial crisis. Steve, you and I go back that far, to the 90s, and you had the non-performing loans that were supposedly going to bring down the banking system. You had all those global financial crises. Many of those things were external shocks. And what we've got now is challenges that seem to be really coming from within. In other words, nobody forced Beijing to make the regulatory changes that ended up erasing a lot of market cap out of the tech stocks. So what we're looking for really is they're going to have to do a course correction, and they're going to have to take firm measures that get confidence back and stimulate the consumer economy. Right. That's really the key here. So those are the things to be looking for at this NPC. Very consequential meeting.
Well, then let's look at it through the lens of foreigners trying to do business in this environment with the increased bifurcation of trade and policy uncertainty, both in China as well as in the United States. When there's policy uncertainty, investment money stays on the sidelines. And we all know that the heady days of billions and billions of dollars of profits for big American companies in China are perhaps over. What would you like to see out of Li Qiang's work report that could possibly lend confidence to American companies that want to pick up investment here instead of continually staying on the sidelines and potentially losing more market access and profits?
Yeah, you're exactly right. It's visibility into the future, understanding what's coming in the regulatory environment. In other words, the measures that were taken 4 years ago, they were explained, but what foreign companies are really looking for is visibility into the future. What is going to be the relationship between private enterprises and the state-owned enterprises? What is this economy really going to look like going forward? And I think to bring back to the meeting, I'm sure you're going to want to talk about is the meeting with the entrepreneurs about a week, 10 days ago, where they were where Xi Jinping brought them in out of the cold, told them that they were going to be part of this, and gave them an opportunity to pledge loyalty, which they did. But that group is going to be the same as the foreign companies. In other words, we're going to be looking for what are the concrete measures that really put some meat behind those words. So words are one thing, but actions are another. So they're going to be looking for concrete measures that show what is the role of the private enterprises in the economy. Then you mentioned the trade picture. I mean, that really is the problem, isn't it, Steve? I mean, the international trade picture right now, you've got an odd situation where Chinese companies, if you look at their performance and quality, the type of innovation that's coming out of Chinese companies right now, it's second to none. It's fantastic. So I would say corporate performance is actually really good. The problem is available markets, and you're looking at China right now doing extremely well in a lot of markets that don't matter as much. In other words, they're doing very, very well in Latin America, Africa, but it's a struggle right now because of the tension that we have. We've got a struggle in North America, of course. You mentioned the tariffs. The relationship with Europe is not the best. So those are the things that are going to be challenges for the leadership in China right now, and what's going to have to be addressed by the NPC.
Well, you mentioned that meeting between Xi Jinping and the tech entrepreneurs, and it kind of dovetails with Made in China 2025 initiatives to go higher up the value chain. You've also had developments in the last month on domestic innovation as far as DeepSeek and other cheaper models, but very efficient models on the AI space. What is the risk to the foreign companies that want to participate at a time when, barriers to entry are going higher from both the United States and China amid what people are calling a potential trade war?
Yeah, you bring up a good point there about Made in China 2025. And I'm not sure if we're going to see it called out by name in the NPC, because they'd had a real PR problem when it was rolled out 10 years ago. And the foreign community hated it because it showed the declining market share that China was laying out for foreign companies to be available. What's interesting about the Made in China 2025, though, Steve, is you mentioned our friend Bob Thelin. One of the things he used to say was there's another group in China that also hated Made in China 2025, and that's actually the Chinese entrepreneurs. They hated it. Why? Because they didn't like being told what to do. They liked kind of going their own way. And they felt that it was too heavy-handed of the government. I'm not saying all, but that was sort of a general feeling within the entrepreneurial community. Now we're in a different period. I think what we've seen is there's no question but that they're going to, despite the meeting that they had last week or 10 days ago, they're not going to be given the free rein that they've had in the last 10, 15, 20 years. And so that's going to be changing. What we might see in NPC is, even if we don't see Made in China 2025 referred to by name, I think this will be a good opportunity for the leadership to declare victory on that plan. Yeah. And I think that they wouldn't be wrong. I've looked at the plan is actually very quantitative, so it lends well to a quantitative measure. And I've seen that they've come up with a number about 86%, giving them a solid B+. I would agree with that. I would say, looking at those industries that they mapped out to have significant market share for domestic companies. New energy vehicle, the electric vehicles, batteries, all of those kinds of things, the advanced industries. Noticeably, why did they get it 86% and not 100? Semiconductors is noticeably underperforming there.
Right. Hey, Kerr, you obviously, when you were president of AmCham Shanghai, you knew a lot of these American CEOs that came over to run the China businesses, and it was oftentimes, a great career move. Would you say it's a little bit different these days, that it's more of a black mark potentially when you come here because the challenges are just so much more great to have return on sizable investments?
Sadly, Steve, it is a black mark, and in a couple of different ways. I mean, politically, the tension between the United States and China, it's just out of control. The level of distrust, and so people who have spent a long time here in China, they are being asked questions whether they're of Chinese ancestry or not. They are being asked different questions now when they go back to the United States. The other thing is linked to performance. You're absolutely right. I mean, what I'm seeing is I'm actually seeing some specific companies and executives that I know are high performing, but they are now in a low performing market. And so they're getting the blame. And so it kind of reminds me, Steve, of what the playwright George Bernard Shaw used to say about his critics. The critics, you say, my plays were never as bad as my critics said they were, but they were never as good as the critics said they were either. And I think that actually applies to the China market. Back in the go-go days when we were experiencing, double-digit growth, you'd have executives come out from headquarters, and the China ticket was absolutely the ride straight into the boardroom. They'd come out to China, and whether these people, I'm not saying they were not competent, but whether they showed any flashes of brilliance or not, they would spend 2, 3, 4 years in the China market, and then they'd go back to headquarters as conquering heroes. You've got the opposite situation now, where you come out and the businesses are struggling. Let's be honest. I mean, look at the foreign OEM car makers; they are struggling. So those used to be very high growth businesses. Now they're not.
Kerr, always good talking to you. Good stuff. We'll have you back on again. And as we run through the opening days of the National People's Congress here in Beijing, Kerr Gibbs, the former president of American Chamber of Commerce in Shanghai. David, back to you.
Yeah, thanks. Fantastic, Steve. Their comprehensive coverage, of course, ahead of the NPC from our team in Beijing. Just some breaking news here out of the Nikkei, and we're talking about 7 & I Holdings here. Ryuichi Isaka is the CEO. And the Nikkei is reporting that they are set to step down on this report. Shares, as you can see, are spiking 4.5% right now. Earlier, a few days ago, I think late last week, the Nikkei also reporting that Couche-Tard is mulling opening an office in Japan, or considering one at least here, that can effectively make it in a better position to gather information in preparation for a formal proposal to acquire the company you see on your screen. So is this latest development just a step further in that direction? Plenty more ahead. This is Bloomberg. Big trading day in Hong Kong today, biggest one of the year so far, up 3%. Live pictures, of course, of the ceremony, which earlier on saw some of the mascots there really taking the attention. Snow King is still there, as you can see, 30% up in the first day of trade. Let's bring in Felipe Pacheco here to talk us through the significance of this listing so far. So we've seen some of their peers come to market already. Why is this one in particular important?
It's a very interesting deal. Why is this interesting? Well, it's the biggest. By far, for example, if you look at the number of stores, we're talking about 45,300.
That's ridiculous.
At shops
honest,
globally.
yeah.
Of course, most of them are in China. They're expanding in Southeast Asia. Vietnam and Indonesia are also very big markets for them. But just to put things in perspective, this is more than McDonald's has globally. This is more than Starbucks. It's more than KFC. And all of those companies are also listed. So we know those numbers quite quickly. Also, by market share in China, this is the biggest player within this industry that's basically called freshly made drinks. And of course, bubble tea is part of that. But this company also sells a lot of, for example, of ice cream cones and lemonade, coffee with milk and different shapes and forms. So, of course, this is a very, very big name within China. It's a retail name. They sell their products at a very, very low price, around $1 per item. So it's a story about consumption in China. It's been hard. A lot of the players that came to market did not perform well in their first year of trade here in Hong Kong. But at the same time, this is a very good story, and it's still a segment that is doing well within a very tough market overall for retail in China.
Felipe, you have a great story out on the two brothers that founded this company. They've accumulated more wealth than the former CEO of Starbucks, Howard Schultz.
That's correct, Rebecca. Well, of course, we wanted to take a look at who were the names behind the company. And you actually, when you start zooming in, the whole thing started in 1997 with one of the two brothers. He started a shaved ice stall in Zhengzhou. Second-tier city in China, not necessarily Beijing or Shanghai or a place where you would expect a big business to start. But then after 10 years and after a few attempts that failed, he brought his younger brother, to the business. His brother basically modernized the entire supply chain for the company, also started the franchise scheme that we see there today. And basically, it boomed over the past 5 to 6 years with these products that we just spoke about. If you look at their wealth right now after the IPO, they still own around 82% of the company, and together they have close to $8.1 billion. That's more than Howard Schultz, who was basically the name that made Starbucks known as we know it today. Yeah.
Felipe, fantastic. Felipe Pacheco there, our Bloomberg News reporter. 45,000 locations and a mascot that, to be honest, in my opinion, is cuter than the Marshmallow Man. But that's, I guess, irrelevant really to where the market goes.
You're going to get some backlash, Dave.
I might. Calling on the Marshmallow Bullish Club there. I'm not sure there is one that exists right now. Ghostbusters to the rescue. From that, there's no real decent pivot now, though, and segue to casino stocks. Revenue on the gaming revenue, to be more specific here, coming in above estimates in a tentative sign that a slowdown is starting to ease. And as you can see on your screen, substantial gains across the big casino players. Gross gaming revenue up, in case you need a figure here, 6.8% in February. From this, one big developer score we're tracking here in Hong Kong is New World Development.
Yeah, they came out with earnings and perhaps a little bit of a bright spot. Essentially, there was already a bit of optimism around this name because of this plan that they're not going to restructure. They're going to be able to basically figure out, pledge collateral against assets and refinance a lot of their debt. But they did have this number about lifting mainland China sales guidance for this year, including in Guangzhou and Hangzhou, adding a little bit of optimism.
There we go. Stocks up, credits up, plenty more ahead. You're watching The China Show.
Good morning and welcome back. You are watching The China Show. Here's a look at the HSI half an hour into this session. We are up 1.5%. Not the sort of manic Monday that we were necessarily expecting, Dave, after that dust-up in the White House that we had over the weekend. And a lot of news for traders to digest really going into the week. We have the MPC, of course, we have US data coming in as well. And PMI numbers, which came in above expectations too, right? So there's a lot to be hopeful for, given that really the market, if you think about it, and to some extent has been really been a prayer of late, 1.5%. On top of that, you are also getting a lot of supportive news on the data front, to Rebecca's point, right? So sales numbers on EVs, for example, are playing out in EVs. There's a crypto story that's lifting crypto stocks. You have the Macau casino story on industry data there. So you are getting pillars adding to really where we are on a benchmark basis. And in a case in point, as you can see, Feb data on EVs has been generally very good. As you can see, XPOM's leading the charge there. The rest of the region is looking like this. Not as good
as the rebound we are seeing in the greater Chinese markets today. So we're up 0.7%. A lot of that is simply the Nikkei and also where you are on some of the Hong Kong benchmarks. Taiwan, of course, is a drag today because of the reopening. Korea is not trading today. Just keep that in mind. And, of course, the 2s and the 10s on the 10-year yield there, 4.20, 4.25, and just a touch above 4% on the 2-year ahead of that crucial U.S. jobs report, which comes out, of course, later on Friday. But between now and that jobs report, a lot can happen. And to help us understand what to watch in between that, the important items on this week's agenda, Mark Cranfield is here to help us really contextualize, Mark. Of all the events this week, in your view, Mark, what's the most important?
Everything. It's very fluid. I mean, this time tomorrow, we could be on the verge of Trump announcing tariffs on various people, or he may be delaying it. Who knows? But that's certainly something coming. The U.S. data this week will certainly be extremely important. One of the significant things which has happened in the past week is that expectations for an early interest rate cut from the Federal Reserve have become much stronger. So if you look at where pricing is now, we're more or less pricing for 3 interest rate cuts again this year. It wasn't too long ago that we were only looking at 1 interest rate cut, and it looks as though June now is becoming a favorite for people for the first of those. Of course, this is something that ebbs and flows all the time, and if the data this week doesn't match, then there'll probably be another change. But the narrative certainly has been changing to the extent where people are now becoming a little bit more pessimistic on what is happening to the U.S. economy. Consumer confidence is being affected. People are expecting that the jobs numbers will deteriorate in the U.S. because of the layoffs in the government workers as well. So gradually the whole mood is deteriorating a bit. The U.S. equity market is not as rampant as it was last year. It's slightly higher, but not very impressive, really. It seems to be shifting to the rest of the world. There's signs that maybe Europe and even China, to some extent, could be taking over from there. So not as much optimism on the U.S. That's affecting policy here. That's also means that the U.S. dollar is likely to weaken a bit further as well. There's lots of things in flux here, but certainly what that means for the Fed, and we do have Jerome Powell speaking this week, so it'll be very interesting to hear what he has to say, whether he thinks that an interest rate cut is going to be likely, or is he going to stick with his mantra that he wants to be on hold for quite a bit longer. That's looking increasingly difficult, and investors are clearly pushing against that, and we'll probably see more of that this week.
Mark, the Bloomberg Economics take on some of the official PMI numbers that came out for February don't really jive with the narrative that we're seeing today. Essentially, Bloomberg Economics analysis saying that, you know, the positive numbers, the resilient story is masking this issue with demand, fundamental issue with demand that the MPC is going to have to deal with when it comes to stimulus. Just give us your view of what you're making of both the official numbers and the Tyson numbers that have just come through.
On the face of them, the last couple of PMIs are a slight improvement. That's good. I think as far as the MPC, I think in the last couple of years, people have come to be disappointed generally with what's come out of the MPC. It's been a big build up to it. And then once it finally comes out, lots of sound bites, not really very much behind it. Probably that puts it, from an equity market point of view, that probably puts investors in a better position this time around because the bar is so low. They expect not very much in terms of concrete action out of the MPC. Again, there's lots of noise going into it, but maybe this time that'll be a pleasant surprise because at least the AI story has got some traction in China. All the MPC need to do is just to give it another nudge. They just need to say that we're behind it rather than we're going to bring in various measures to try and make it more difficult. As long as they don't do anything to put people off about the tech story in China, as long as benign is the best thing they can do, really. As long as they don't get in the way, they just give it a little bit of a nudge in the right direction, that will probably be sufficient because it really, from an investor's point of view, the MPC is such a low bar. They just need to get over it. And they want to make lots of noise about the 5% growth, which doesn't really mean a great deal. Which sectors are they going to support and by how much are they going to support? If they can just put a little bit of flesh on those details, it may end up being a pretty decent week for Chinese equities, regardless of what comes out of the United States.
Yeah, and particularly any details on strategy, Mark, to help boost consumption. Let me just ask you a final question on Europe. The question of the day, of course, from your team is, can European stocks continue to outperform? And the context, I guess, too, is my question here is, the strategy of going long on defense-related stocks, for example, do you think that continues this week? And, what's your take on the question of the day as well?
again, we're coming from potentially a low bar here. So many people have written off Europe. Oh, the euro could never rally. Europe is not a place to invest in. Politics is such a mess. Suddenly, this weekend, it looks as though European leaders actually might be coming together with some kind of plan to impress investors that, yes, we are on the same page. We can do something to promote Europe together. That is not what was expected even just a few days ago, really. So all they need to do is just to keep that going. Of course, there's a lot of things that could go wrong in the meantime. But if the European leaders can actually come up with some kind of a reasonable plan that includes increased spending, whether it's on defense as well as some other things as well, that's positive for the euro, that improves sentiment towards the whole region. And of course, equities are one of the things that are likely to benefit from that as well.
That was Mark Cranfield in Singapore for us. And in case you're curious, that's Mark Cudmore's left arm as well in the shot there for us, right behind him. Right, as we await, of course, the NPC, you can read our Trader's Guide prepared by our equities team for the Asia Pacific. It looks at opportunities, really, in the tech sector, long-standing challenges in real estate. Check that out. Subscribers can find it, of course, on the terminal and also on Bloomberg.com.
Yeah, and also coming up, we'll be able to dig into some of our top stories today with former PBOC advisor David Daokui Li joins us to discuss what to expect out of China's MPC this week. Plus, we are unpacking the latest push by European leaders to provide security guarantees for Ukraine.
Good morning and welcome back. You're watching the China Show. One major item on the agenda this week, of course, is the NPC. Investors are looking ahead to that. Things start, of course, on Wednesday. Not just a bit of a curtain raiser and some commentary coming through here from the analyst community as we await and sort of manage our expectations ahead of that. Asia Society, Beijing has a history of failing to follow through on commitments to boost domestic demand. No transformative policies appear to be in the pipeline. That's according to Neil Thomas there in Jingqian out of the Asia Society. Flip the page. HSBC has somewhat of an opposite view as it pertains to maybe be prepared to be perhaps surprised here. Beijing to adopt a break-the-mold domestic policies to counter these external headwinds and consumption as key areas of focus. Nomura has also put out their note to clients. This coming through, of course, out of Ting Lu, their chief China economist. There, while markets might call for a China Sputnik moment, Beijing might still need to tread cautiously with regard to cleaning the mess in the housing sector. And Goldman Sachs actually talked to a lot of its clients onshore, and there are low expectations there, according to Goldman Sachs. Many clients flag that they have low expectations for other fiscal numbers as it pertains to some of these special quotas, of course, for central and also local government special bonds. Rebecca.
Yeah, what's interesting here, I think, is that a lot of these banks and various institutions and think tanks are really talking about actually a very similar and quite tight-bound set of numbers when it comes to consensus. Yeah. But the views and the perspective on how that's happening, very different, obviously. And joining us now is former PBOC advisor David Daokui Li. He's currently director of Tsinghua University's Academic Center for Chinese Economic Practice and Thinking. My colleague David just went through some of the expectations that think tanks, banks have going into the MPC. I want to ask, what do you think it is that people are getting wrong in terms of their forecasts, or what it is that we are not paying enough attention to?
Well, I think people are wrong in two regards. Number one, today's policy-making process, frankly speaking, is more centralized than before, okay? And that's a fact, okay, for good or for bad. Second, today's policy-making framework or mentality is relatively cautious. That is watch and move, okay? In a way, it's a little bit the opposite of President Trump 2.0. Okay, he's a fast mover and oftentimes not being able to follow through. Okay, so this time around, okay, the overall attitude from the very top in China is super clear. That is boosting consumption. Private consumption is job number one. is even more important than enhancing China's capacity of innovation. Okay, and second, this policy indication may not be all reflected in the forthcoming government work report. It will be flushed out during the whole year, okay? When there's not enough outcome from the stimulus policies, there will be more. So this is, I think, this is the key thing that people in the investment bank community may have missed.
David here. To what degree of clarity or detail, and markets are trying to figure out how much effectiveness many of the measures that have been announced and might get announced this week will have on boosting consumption. So my question is, how much detail do you think we will likely see as it pertains to that strategy of boosting consumption?
Well, again, to be very frank, I believe that the government work report to be released in 2 days will still be very principled, very general, okay? Indicating strong commitment of the government to boosting private consumption. However, when it comes to specific details, it may not be able to surprise people, okay? However, let me go back to my first point. That is, the tone or the principles nowadays are important, because that means that after the government work report, there will be more follow-up policies. There are more additional policies after the work of the government work report. So in other words, pay more attention to the principles, to the tone of the report, rather than to some specific details of the report.
David, you've been an advisor to Beijing for many years. I want to ask, how do you interpret Beijing's mindset when it comes to private enterprise and the role that private enterprise is going to play in, for example, the important consumption story that you mentioned?
Well, the top decision makers have now come to realize that the private sector is tremendously important, especially in terms of technological innovation. Okay, we've seen lots of examples. Almost all the technological breakthroughs have come from the private sector. On this point, the top decision makers have fully realized. However, as I said at the very beginning, there is a lack of specific policies to support the private sector, which will come along relatively slowly this year, maybe next year. So again, it's an issue of general statement followed by specific policies. There is a time gap. So I think in this regard, many people from outside may, for good reasons, may become relatively impatient because they don't understand the today's policy-making process in China.
Yeah, I think that's a very important sort of nuance to take there. The lack of details might not necessarily mean the lack of urgency, I guess, just to underscore that point. I was wondering if you could flesh out as well some of that other point that you mentioned around industrial policy. What clues are we looking for there?
Well, industrial policy, interesting question. I would argue that it is not the traditional industrial policies which have propped up many sectors in China. Rather, it's a whole package of government incentives which helped local governments to support local investments. So today, in this year, I actually anticipate the reverse or negative industrial policies to rein in the overzealous of local governments. For example, in the EV industry, in the electrical vehicle industry, there may well be policies to restrict overall production capacity. And maybe, hopefully, there will be market mechanism for enterprises to trade their production capacity. For example, new entrant will have to buy a license from existing enterprises in order to produce a new model. So I think in Beijing, the mentality is to rein in excessive competition due to excessive entry in certain sectors.
Do you think, as a follow-up to that, do you think the government needs to do more as far as encouraging consolidation within those sectors beyond sharing of capacity?
Oh, absolutely, absolutely. But the consolidation itself sounds very easy, but it's hard to implement. There's a need for a market-based mechanism. If the central government goes around saying, hey, enterprise A should be combined with enterprise B, there's zillions of counter-arguments. So it's much better to set up overall setting as of the total production capacity, as the central government has done with the steel industry, with the aluminum industry, and then let enterprises trade among themselves. That's a much better, much more effective way. And I do believe the top policymakers in China have this kind of market mentality. They may very well be do this in the near future.
David, to your point that we shouldn't be pinning all our hopes on the MPC and taking a step back, I mean, you've written and spoken before that in some ways the years of easy growth for China are behind us, the years of stimulus-driven growth, property-driven growth. China now has to shift to a more sustainable model of growth. I want to ask what you think the key steps are, and if there is willingness in Beijing and the political sort of capital to try and tackle some of those difficult long-term reforms.
Well, there are actually two things. Number one is to deal with the aftermath of the very rapid infrastructure investment, which actually is the mounting local government debt. Local governments were the strongholds of infrastructure investments, and unfortunately, they have been using short-term debt to support these long-term infrastructure projects. So there's a huge amount of local debt, which my team calculates to be as high as 100% of GDP. And this issue has to be resolved. That the only way to do it is for the central government to issue central government debt to swap out some of the local government debt. Otherwise, local governments will always behave very strangely. For example, they may go after private enterprises for tax revenue in order to pay back their debt. That's number one issue. So deal with the aftermath of the rapid infrastructure investment in the past 2 decades. Number two issue, to install a new set of incentives on local governments to induce them to support local consumption. China today is in its interesting situation. It's like consisting of 31, 32 mercantilist local governments. Every local government is wanting to produce, hoping the other governments buying the products they produce. So today, we have to, I think a reform has to be done to let local governments to share some of the tax revenue from the sales of the products other people produce. Today, tax revenue comes from production. So the tax system should change so that local government get tax revenue from consumption. So that's a major shift.
I want to pick up finally on the issue of deflation, which for a while has been really a sensitive topic of discussion in Beijing. Do you think that Beijing and top policymakers have done enough on deflation? And do you think there's a shift in mindset on what policies we see coming through this year to tackle the deflation risks?
Well, the top decision makers have come to full realization of the issue of the price declining. So I think somewhere they have already stated that this year they will help the overall price level to have a moderate increase. It's already openly stated. The key issue, the number one issue, is to help local governments to restore their purchasing power. Local governments collectively, arguably, are the largest buyers in the marketplace. They buy many things and they do many, many things. They are even bigger than households. But the local governments are now running out of ammunition because they are trying to pay back debt. So again, the issue comes to swap out local debt to the central government by issuing central government debt. By the way, the central government debt is only 25% of GDP, among the lowest in the world. There's tremendous room for the central government to issue new central government debt. So I do believe in the coming 1 year, this policy will be gradually implemented. The political will, the policy will is there, but it takes time for the whole system to change. There's tremendous inertia in the policy-making community.
David, final question for you. We've yet to talk about tariffs in this specific conversation. And the reason I frame it that way is I'm curious to what extent tariffs or the external challenges will be referenced these next few days.
Well, let me be very frank, okay? I strongly believe this time around, tariff is no longer a big issue. I would even, if you give me an order of 3 top issues in China or challenges in China, I don't even put top 3, even among the top 3, the tariff from President Trump. In fact, the whole economy was preparing for 40% or even 60% of tariff hike from President Trump. Now he's only imposing 10%. Of course, there are indirect tariff upon Chinese products from Mexico, from Canada, from Europe. But overall, it's still smaller than people anticipated. It's smaller than the year of 2018. So this time around, the Chinese economy is fully prepared. I do not think the tariff is a big issue. The way to deal with tariff is the same as deal with the other issues in Chinese economy, that is to boost domestic consumption. And on this issue, there's already tremendous discussions, and also a lot of policies will be implemented down the road.
Fantastic insights, and terrific insights really into what to really pay attention to this week. David Daokui, there, former PBOC advisor and Tsinghua University director, live for us there on what a curtain raiser, really, as we await the NPC this week. We're up 2% on these markets. This is Bloomberg. Right, welcome back. We're looking at bubble tea stocks. One trading debut, of course. It's quite obvious what that one is. It's the first one. I mean, they can't all be true. At some point, one of this has to give to be. I mean, 5% down on one, 11% down on the other, 30% up on one. Markets need to make their minds up, really. But again, the aberration of a trading debut, I guess, does this as well. We can talk more about this later. Biggest debut so far of the year, Mixue Group here in Hong Kong. This is Bloomberg. Right, welcome back. We're just headed into the Tokyo lunch break. By the way, everyone who ran the Tokyo Marathon on the weekend, congratulations to you. Nikkei is up 1.1 going into the break. Topics index slightly better to the upside. 1.41% on that's the 10-year yield. The 30-year yield at 237 is a level that, we haven't really seen, let's call it nearly 20 years now, since 2008. So I'm rounding up, but yes, we are back to those generation ago levels there on Japanese interest rates. Defense-related stocks, who would have thought we'd be talking about defense-related stocks in the Japanese context? But yes, such is the world that we are in. And as you can see, certainly pledges for more support for Ukraine across Europe, and certainly the need for them to then increase their own defense spending has really played out as far as the Japanese story is concerned. We're looking at that on the way up. By the way, in case you missed it, the Korea iteration of this story has also been playing out. We put a story out on that a few weeks ago. Pay attention to that. 7&I is a stock that we've been tracking all morning, and certainly with greater attention and relevance in the last, I would say, hours. So following this report out of the Nikkei that the CEO is about to go, could open up the door to that deal, of course, with the Nikkei also reporting separately that Couche-Tard is considering opening an office in Japan as they look to maybe prepare a renewed bid for the company. Shares, though, since that point in time have retraced low, where we were up as much as 4.5% to about 5%. So, yeah, we will table that story for now. But again, lots to talk about in Japan, and we might get more details on this story a bit later on in the show.
Yeah, and a little bit of breaking news as well. Just switching back to China here, we have Baidu planning to issue $1.4 billion worth equivalent of offshore yuan bond. I'm just seeing here, I think that is going to be its first ever dim sum bond offering. The company has about $6.2 billion, I see on the terminal, of dollar debt so far. And of course, the story about debt issuance has been kind of quite prominent this year, this ability, whether or not we're going to see Chinese corporates, stronger Chinese corporates, being able to return back to the market. Back now to our other top stories this morning, really a geopolitical theme that has dominated so far today. Western Europe is rallying around Ukraine amid doubts over US support. Ukraine's Volodymyr Zelensky was in London on Sunday meeting with European leaders, as well as the NATO chief and Canadian Prime Minister Justin Trudeau. German Chancellor Olaf Scholz says the continent cannot allow a Ukrainian government that, in his words, danced to the Russian tune. Elsewhere, Italy's Giorgia Meloni has also weighed in, stressing the need to keep the transatlantic alliance with the US intact and avoid divisions among Western nations. And just flicking forwards, Canada's Justin Trudeau also expressing his support for Kiev, saying everything is on the table for his country's role in the conflict.
Yeah, let's see how and we can extrapolate the various scenarios forward here on the back of that global-wide live-streamed verbal dust-up at the Oval Office late on Friday in the U.S. Joining us now is Jared Mondschein, Director of Research at the Sydney University's United States Studies Center. Jared, a pleasure to have you on the show. Thank you for joining us fairly last minute. I guess just to start off and to understand whether a deal was inevitable, let's put it that way, that's a question for me. Do you think we would be talking about a deal being in place right now were it not for those last 10, 15 minutes of that dust-up?
It's really hard to say at this point because it's important to note is sort of the inside baseball of that deal was that after that press conference, they were supposed to work through the rest of the afternoon on that deal. And you have to look at sort of the fallout from that deal is in many ways, or the lack of a deal, I should say, in many ways, we've seen unprecedented commitment. And so as a result, I think what we're seeing is Europe really stepping up to the table in a way that we had not seen them step up to the table before. Same with Canada. I think in many ways we've been talking for decades about a wake-up call from Europe about needing to do more. And I think this is probably the most aggressive wake-up call they've had in the history of the NATO alliance.
I guess the other follow-up point on that, though, is the ways in which Europe potentially will come short here. To what extent, do you think that the US is weighing that possibility? And, of course, to what extent is this all potentially part of, I guess, a broader strategy actually to sort of shake Europe up to really kind of stand up and take a bigger role where Trump and the US still may kind of end up eventually lending their support in some kind of deal?
Yeah, I think there are too many structural interests for the U.S. to not want to support this in some way. It's really a question of how they're going to support this. I can't emphasize enough, though, that it's a bipartisan area of consensus that Americans have wanted to do more since the Eisenhower or Truman administrations. I mean, even look at the Obama administration. You look at what his Secretary of Defense, Bob Gates, said to Europe, and he said explicitly that he could very easily see a future scenario where future U.S. presidents would not be as willing to come to the table and support Europe because they had just not done enough. So I think in terms of strategy, I wouldn't look too far into what Donald Trump has said because it's really hard to ascertain his strategy. But in terms of where the structural trends are going and what we can expect no matter who is president, Europe doing more is something that every president, including any Democratic president, would definitely want in this situation.
Let's look at the extreme scenario. What happens in the event of a sudden halt in U.S. support for Ukraine? Just play that scenario forward for us from the perspective of the Europeans and also the Russians.
Right. So even without U.S. support, there's a question of, are the boots on the ground from Europe going to be backed by the NATO treaty? And what sort of role do those Europeans play? Are they staying far away from the front line? Are they sort of supporting from behind? I think more than anything else, we need to see what the Europeans are willing to commit and how much they are willing to commit. And then also, there has to be negotiations with the Trump administration. NATO has become more interoperable since 2022 than ever. And so there's a lot of different scenarios that NATO has operated in the last many decades, especially since Russia has become more aggressive. And I think there's a lot of different ways that they can cut this. There's not one sort of size-fits-all that fits the scenario moving forward. So that's why there's so much that needs to be done within the European community to decide what they're willing to do.
Jared, you did mention the bipartisan support for and the need and the feeling that Europe should be doing more and taking on a bigger role. Are you expecting to see, or have we seen very vocal response from the Democrats to what has happened between Trump and Zelensky? Should we expect a bigger reaction from the Democrats?
That's a great question. I think there's an issue of politics here. Unfortunately, NATO has become a sort of partisan issue at this point, and Ukraine itself has become a partisan issue. And then the Democrats are, tweeting up a storm and rhetorically really standing up for Zelensky and against Donald Trump. And many former Republicans, including many former Bush administration officials, are standing up against Donald Trump and J.D. Vance. But the question in my mind is, what are they willing to commit? Are they willing to commit further funds to Ukraine? Because even the Biden administration, in their last installment of financial support and military support to Ukraine, said that there's no more support coming in the rest of 2024. So the question is, it's one thing to provide rhetoric and to then sort of criticize Donald Trump for what they view as a reprehensible behavior from him and the vice president. It's something altogether to commit some resources. What does that actually look like, and how can Congress move ahead in this environment?
Okay, Jared, thank you so much for joining us late your evening. Jared Mondschein, Director of Research at the United States Studies Center of University of Sydney there. And turning to some breaking news, Japan's Nikkei News is reporting that the CEO of Seven & I, Ryuichi Isaka, is stepping down. Bloomberg breaking news editor Gareth Allen joins us from Tokyo with more detail. Gareth, just give us the highlights here.
Yeah, that's right. So, report in Nikkei just a few minutes ago says that the current president and CEO of Seven & I, Ryuichi Isaka, is set to step down, and he is going to be replaced by Stephen Hayes Dacus, who is a sitting board member of Seven & I and has had a fairly storied history in Japanese retailing. He's been at fast retailing, for example. He was also the CEO of Seiyu at one point as well. So that's just breaking now, that we're expecting that the board will make a decision on that shortly. And there should be an announcement possibly today, possibly in the next couple of days.
Okay, does this then, I guess the next question really goes down to back to the potential deal. Does this make the approach from Couche-Tard any more likely to happen, looking at this new approach?
Yeah, well, that's right. So, I mean, it was only last week that we learned that the proposed founding family buyout was the plans for that were scrapped. So it's back to the two options they have on the table now, which is the Couche-Tard takeover or doing it alone. I don't think at this point we have really any strong indication of whether the new CEO is going to be stronger for the Couche-Tard deal or against it. We'll have to wait and see on that one. But again, their options are just those two at the moment. So we'll be watching this as it pans out to see which track they take.
Gareth, fantastic. Thank you for joining us very last minute there as well here on this breaking news editor there, live for us out of Tokyo. Right, we're turning our attention back to China on the other side of this break, so stay with us. This is Bloomberg. Good morning. Welcome back. You're watching the China Show. It's time now for our trending in China segment. We'll look really at some top headlines across official media this Monday morning. With the next 10% U.S. tariff on Chinese imports set to effectively take effect this week here, China Daily is out with a strongly worded editorial that says that Beijing will not give in to pressure and blackmail, warning that the U.S. and any other country that imposes tariffs there will be countermeasures. Now, meanwhile, you have lots of coverage on the economy as well ahead of the NPC, as policymakers are seeking to inspire confidence. Splashed across the front pages of state newspapers is a piece on President Xi's support for the private economy. Now, the article quotes Xi saying that he has always supported the sector, listing his efforts from his time as a provincial official to his recent meeting with business leaders.
Yeah, and the Securities Journal also reporting on calls from experts to stimulate domestic consumption by boosting fiscal support. The article says the government should increase spending while making structural adjustments, focusing on areas that benefit people's livelihood. And speaking of the economy, state media is projecting an image of strong growth, criticizing those with a different view. We had this commentary from Xinhua slamming Western media for what it calls, quote, a relentless fixation on peddling narratives of China's economic doom. It says China's challenges are temporary as it transitions to a high-quality development, that the government has confronted those challenges with a comprehensive policy toolkit.
Yeah, too short-sighted look at the big picture is, I guess, a summary of that Xinhua report, or the piece, rather. Now, investors will also be watching the NPC for any measures to help lift or, I guess, continue the momentum, early momentum we've seen here in the property sector. Let's bring in Rebecca Tang out of Fitch Ratings, Director of APAC Corporate Ratings, is here with us to have a look at specifically the property sector view here, Rebecca, of policy and the industry and this recovery. Should I call it a recovery that's taking place? How would you describe the current situation of the housing sector right now?
Well, looking at the first 2 months, sales data of the top 100 Chinese developers. So the sales decline of 6% is slightly ahead of our full-year forecast of a negative 15%. However, we see uncertainties in the sustainability of such a momentum because we haven't seen stable or sustainable recovery in terms of the home prices, especially for the secondary home market. So we continue to forecast a negative 15% decline in terms of the contracted sales and maintain our deteriorating outlook for the sector for 2025. Besides, we also see diverged performance between the top industry leaders, which are SOEs, versus the POEs, the privately owned developers. And we see continued polarization in terms of the industry sales for this year.
In terms of that, as you talk about the sort of SOE strength that we're seeing through, to what extent is it going to be able to offset the weakness that we're seeing in private developers? And do you see the state support for Vanke? Do you see that as a model that could potentially play out anywhere else?
Yeah, so the privately owned developers still account for a significant contribution to the overall contracted sales. And we still have negative outlook on about half of the rated issuers in this sector. And this negative outlook, or rating watch negative, mostly is driven by uncertainties surrounding their contracted sales, stability in the near term, which is the determining factor for their cash flows and their financial profile. And for Vanke that you have mentioned, we believe the company's uncertainties surrounding its near-term sales remain the driver to our rating watch negative, and we have downgraded the company to B- back in January on the back of the liquidity buffer against its sizable capital market debt maturities in 2025.
What would be the most important leading indicators of the trend for ratings this year? I know you can't comment individually, of course, on what your actions might be on specific issuers, for example, but so far what we've seen is I think we've seen more downgrades from you guys than upgrades so far. I think mostly in high yield, 7 downgrades, I think 1 upgrade, correct me if I'm wrong, on investment grade. So what are the key leading indicators here that you're tracking?
Yeah, so we are continuing to track the monthly sales data. Okay. Which we have mentioned that we see divergence performance between different developers, especially from the top industry leaders versus the smaller companies. So we believe this sales data will continue to be a key driver in terms of monitoring its stability of the cash flow generation and their access, continuous access to funding.
Yeah, I mean, just to Dave's point, talking about the sort of where we are, thinking where we are in the cycle in terms of where we are as well, the downgrades that we've seen so far this year. Do you have any expectation that we'll start to see that bottoming up? If we can flick to the chart that we have as well, 7 downgrades in that high yield space, 1 in the IG. When do we start seeing more upgrades? Or are we still thinking about fallen angel risk, downgrade risk?
So for the Chinese home builder sector specific, so we believe most of the negative rating actions have dissipated in the past 2 years, given that the remaining rated companies are mostly SOEs, which generally have more stable funding access. So we believe the rating action have dissipated in the past. So we continue to monitor how the overall industry is performing in terms of the sales as well as the price performance.
So we've talked about one source of cash flow, which is sales. What about financing, and how would you describe the financing environment right now, particularly for the POEs?
Yeah, so particularly for POEs, the funding access will mainly come from the onshore bank funding. As we see increasing use of secured funding channel to replace the unsecured funding channel, which they used to enjoy in the past. So we expect them to, for example, for companies which have still have sufficient large unencumbered asset pool, in their asset profile, they may continue to enjoy these funding access by securitizing of their assets. But that will also be, need to be supported by their financial profile, which will be driven by the cash flow from their sales.
Actually, I follow up there very quickly. We know officials have encouraged banks, to your point, to really lend beyond working capital, say, to these developers. Have you noticed a reduction in credit standards there because of this push to help developers, or there are no details on that just yet?
So I believe the banks will continue to assess the quality of the assets for their collateral loans. So companies with high exposure to quality assets in the higher tier cities may continue to benefit from this funding access.
Okay, Rebecca. That's Fitch Ratings Director of APAC Corporate Ratings, Rebecca Tang, joining us there this morning. And there's plenty more ahead. You're watching The China Show. This is Bloomberg. Good morning and welcome to Monday. You're watching The China Show. It certainly does feel like a Monday. Okay, some of the big corporate stories that we are following today. Chinese AI firm DeepSeek says its theoretical profit margin could be more than 5 times its costs. The startup revealed it saw a 545% profit margin for its V3 and R1 models during a 24-hour period. But it did add a disclaimer that its actual revenues are substantially lower due to factors such as only some services being monetized and discounts during off-peak hours. Prada is said to be moving closer to a deal to buy Versace from Capri after agreeing to a price of nearly $1.6 billion. Sources say talks are progressing after initial due diligence didn't find any risks, and the deal could be finalized in March. An acquisition would allow Prada to create a larger Italian player to compete with rival luxury groups LVMH and Kering.
I'm going to borrow that phrase from DeepSeek for future dust-ins with, well, it depends on the situation. So My theoretical future self, in case someone comes in and decides to criticize me, if my producers go, oh, David, you should stop stumbling less, well, my theoretical future self will actually be much better at delivering the news for you. If someone else goes, oh, David, you should have done this, David, you should have done that, well, my theoretical future self then would be in this sort of sense. That just able to just buy us some time here because there's actually still a bit of time. Anyway, I've dusted that up, and here's a number for you: $8,197 is the difference between the Bitcoin price now and the bottom yesterday. So that's almost a cool $10,000, and reason why you're seeing crypto-related stocks to the upside today. Software. Flip the boards, please, and let's have a look at many of these names, and as you can see, double-digit gains there as well. On the back of that theoretical profit margin comment coming out of DeepSeek, I guess they're not lying, right? It's extrapolating given realistic and real information right now, and as you can see, it's playing out quite noticeably. And there were firms that were invited by officials, PBOC, CSR, joint meeting to discuss financing options and improving the situation there. Those firms are also to the upside today. Right, that's it from us here on the China Show. We'll see you all tomorrow. This is Bloomberg.